That payoff chart you are looking at on screen, that's an iron condor, probably the most popular defined risk strategy among nifty option sellers. And here is the strange part. It wins most of the time, week after week, more of your trades come back green than red. So why do so many people running it still end up losing money? By the end of this video, you will know exactly how it is built, why that high win rate is actually a trap, and the one expiry day mistake that quietly turning a winning trade into a losing trade. Okay, let me actually build this thing with you in plain English. Because the moment you see how it is made, the trap kind of explain itself. And for now, forget the scary name. Uh, This whole strategy is really just one simple Lego brick repeated twice. That brick is called a spread. Let's understand what spread is first. A spread is just two options sitting side by side. You sell or buy one to take some cash in, and right next to it, you buy or sell a cheaper one as a seat build. So if you are wrong, your loss is capped. Because someday Nifty can just gap against the option you sold, and you don't want to carrying that kind of open risk. That's the whole idea. Now let's build the first brick, a bear call spread. The name is composed of two words, bear and call spread. Let's understand. So why bear? Bear means I am betting the market will not rally. Call spread because I am building it out of call option. Okay, let's take an example. Let's say I think Nifty stays below 24,500 this week. So I sell the 24,500 call and collects 35.75 points. Now, on its own, a naked short call is scary for me. If Nifty rips up, my loss is basically unlimited. So I do the seatbelt thing. I buy the 25,000 call for 3.65 points. I keep about 32 points of credit, and now, no matter how high Nifty goes, my loss on this side can never be more than 500 points gap between my two strikes. Selling a call and buying a higher one to cap it, that's called a bear call spread, a defined risk bet on stays below. And if you look at the payoff chart, I only make money while Nifty stays down near my short. And the moment it pushes past 24,000, the loss just goes flat, fixed. That flat line is the hedge I bought doing its job. Now let's suppose I do the exact opposite. So that gives us a bull put spread. Same trick, the two word bull means this time I'm betting the market won't fall. Put a spread because I am building it out of puts. So now I am hoping Nifty does not drop below 23,500. It stays there or goes up. I sell the 23,500 put for 38.90 points, and as my seed build, I buy the 23,000 put below it for 8.70 points. I keep about 30 points, and again my loss is capped at the 500 point cap. On the chart, it's just a mirror image. I make money as long as Nifty stays above 23,500 and my loss is fixed. Even if the market gap straight down to 22,000 the morning after I sold, my max loss is just 500 points. Okay, so let me put both of these payoff right next to each other for a second, and my call spread on one side and my put spread on the other. And now just watch what happens if I slide them together. If I take both of these position at the very same time, look at it once, and there it is. They snap into one single shape, and just like that, I have boxed Nifty in. I make money as long as it stays between 23,500 and 24,500. That's the iron condor. The two credit spread, one on each side, four legs, one net credit, risk capped both ways. And really, that's the whole soul of this trade in one sentence. A condor is a bet that the market moves less than its own forecast. I am getting paid a premium to bet Nifty just stay inside a range until expiry. So the only thing that ends up mattering is how far does Nifty actually move versus how far the option market expected it to. Hold on to that line because it's the key to everything that goes wrong later. And also, here is the quite little bonus most explainers skip because only one side can ever be breached by Nifty. At the expiry, Nifty can't crash below 23,000 and rip above 25,000 in the same way. Adding that second spread actually lowers my risk. Look on its own, my call spread makes about 32 points and risk the rest of its swing about 468 points. But the moment I add the put spread, I pocket its credit too, another 30 points. And since both sides can't blow up in the same week, that second credit just sit there, cushioning my loss. So I take in 62 in total, and my worst case actually drops and from 468 down to 438. I get paid twice and I can still only lose once. All right, let's understand the shape of this box a bit better. And here's the nice part. Once you have got it, the whole trade comes down to just three numbers, and you know all three before you even place a real trade. First, the max profit. That's simply the credit you collected. In our example, 62 points times the lot size. That's the ceiling. You can't make a single rupees more than that. If Nifty expires anywhere inside the range, you just keep the full credit. Second, your max loss. Look at the payoff chart. See those two slanted lines on the side. Those are the wings of the condor. The width of a wing from where the loss starts to where it goes flat is 500 points. So your max loss is that wing width minus the credit you took in. So 500 minus 62, which is 438 points. And that's all you can ever lose, fixed upfront. The market can gap up or down by any amount overnight, and you will never lose a rupee more than that. And third, your break evens. The 2 point where those slanted line cross back over zero. Push the credit just past each short strike and you get 23,438 on the downside and 24,562 on the up. Finish anywhere between these two lines and you will walk away with a profit. Now, here is the idea that makes the whole thing click. An iron condor isn't really a directional trade at all. I'm not betting Nifty goes up, nor I am betting it goes down. I am betting on volatility, on how much it moves. And here is the thing. Before I sell anything, the market is already telling me how far it expects Nifty to move this week. That number is just sitting there in the option prices, and it's exactly what I use to decide where to place my strike in the first place. That bell curve on the chart, that's the market own forecast, basically the odds of where Nifty actually lands by expiry. So the first question is, how far does the market think it will move? Because that width is the number everything else hangs on. And I don't want you to just take my word for the size of that forecast, because the market actually quotes it to you in two ways that lands on the same number. The quick way, just look at the money straddle price. Buy the 24,050 call and 24,050 put together. It cost about 373 point. That number basically is the move the market is pricing. The precise way is a small formula, price into implied volatility into a square root of time left. And for our snapshot, that is 24,446 times an implied vol of about 15%, scale down for the 1 week of time left, and it comes out to be 468 points, just under 2%. Same answer both way, and that's exactly what those two teal dash lines on the chart are marking. One on each side of today's price with arrow stress across the top between them. That's the whole span, is the implied move. About 468 points to each. It's basically one standard deviation. And don't get hung up on the formula. That's the proper option pricing math, and I'll give it its own video another day. In plain English, all it's really doing is deciding what an option should cost at any given moment, how much time is left, how jumpy the market is right now, and more time or more fear, pricier option. That's the whole engine underneath. Now let's see the chart again. Look closely at where my two short strike, the orange lines, sit against those teal edges. My 24,500 calls sit right on the teal line, bang at the edge of the move. But my 23,500 put, it pokes out past the teal line, even further away from the center. And yet it costs more, 38.9 versus 35.75. That's the skew. The market pays up for crash protection. So the downside is always priced richer than the upside. My short shit little unevenly, snug on the call, a bit looser on the put. So strip it away and the bet is dead simple. I am betting Nifty move less than the market just priced in, and I am selling slightly overpriced insurance, and every day it blows up, time decay pays me a little. Now you can see why I draw the bell on top of my payoff in the first place, because it tells me the one thing the colored zone can't. The green and red show me what I win or lose. The bell shows me how likely each of those outcomes actually is. So watch where it lines up. The fat middle of the bell, where Nifty most probably lands, sits right over my green zone. The market itself is telling me most weak prices stay in the box and I keep the credit. And the thin tails way out where the bell flattens at to almost nothing, though sits over the red. So a big loss isn't impossible, it's just rare. That overlap, fat middle on the ground, thin tail on red, is the entire condor in one picture. I win small, I win often. And that nice white zone is exactly why the win rate looks so good on screenshots. But it's also the whole setup for the trap. So here is the part nobody's selling you or course wants to say out loud. Look at the payoff again. A win small, 62 points, and a win often. But on the weeks I do lose, I lose big, all the way up towards that 438 points. Look at the bars on the screen. Seven little green wins and one red bar that swallows every one of them. And these strikes I would have to string together roughly seven wins in a row just to pay one single trip to the wing. And here's the killer. It wouldn't matter even if you won way more often. Pictures winning 75, even 80% of your trade sounds unbeatable, right? But win small a bunch of time, lose big just once, and you can still end up flat or even negative. With a win rate that looks amazing in a screenshot. Win rate is marketing, expectancy is the reality. Now, to be fair, most losing weeks don't run all the way to the wing. You usually lose some partial amount, not the full max. So, is this structure actually profitable on the Nifty once you add up everything? That's not a question you can answer with a payoff diagram. You answer it with a data, and that's exactly what my next video does. And we haven't even talked about costs yet. And there are two of them quietly eating into 62 points credit. The first one, remember this is a four legs, not one. Four legs means four times the brokerage, four times the sleepage, and I pay all of it on the way in and then again on the way out when I close. So that headline 62-point credit, I never actually keep all of it. And this is the expiry day mistake I promised you at the very start. If one of my short legs finishes in the money and I just let it ride into settlement, there is a tax on that ITM settlement most beginner never budget for. And it can quietly turn a small manageable loss into a much bigger one. The fix is boring, but it matters. Don't let a breach short sit into expiry. Close it out before settlement. So, is the Condor just useless? No, not at all. It actually has a real place. You just need three things to line up at the same time. One, I expect Nifty to stay range bound, quite going nowhere. Two, implied volatility is high, so the premium I am selling is genuinely fat, not cheap. And three, I want defined risk, a loss capped in advance. Instead of a naked strangle open tail that can run me right over, miss those three, and I'm just selling cheap insurance for a tiny premium where carrying a fat tail for a no reason. So that's the iron condor in theory. Clean capped, win most of the time. But theory and 7 years of real nifty data, March 2020 and everything else are two different animals. So in the next video, I take this strategy and run it through every single market since 2019. Real fills, real cost, that expiry tax included, and I put it head to head against a naked strangle and against just doing nothing at all.